The crisis reached a tipping point when the Knickerbocker Trust Company, New York's third-largest trust, faced a massive run. Its president, Charles Barney, was linked to the failed copper scheme, and confidence evaporated. On October 22, 1907, depositors lined up for blocks to pull out their savings. The trust's reserves were quickly exhausted, and it was forced to suspend operations. The failure sent shockwaves through Wall Street, as other trusts and banks began to wobble. Morgan orchestrated a series of emergency loans to prop up struggling trust companies. He convinced other bankers to pool their money, creating a private bailout fund. When the Trust Company of America faced a run, Morgan dispatched a team to count its assets overnight and declared it solvent, restoring confidence. He even used his influence to get the U.S. Treasury to deposit $25 million into national banks, which then lent to trusts. These actions slowly stemmed the tide. As the banking crisis deepened, the New York Stock Exchange faced its own catastrophe. Brokers needed cash to cover margin calls, but banks refused to lend. The exchange's president rushed to Morgan's office, warning that the market would have to close early. Morgan knew that closing the exchange would signal total collapse. In a dramatic move, he called together the city's bankers and demanded they provide $25 million in loans within minutes. The money was raised. The panic threatened to topple a major brokerage firm, Moore & Schley, which had used Tennessee Coal, Iron and Railroad Company stock as collateral. If the firm failed, it would trigger a cascade of bankruptcies. Morgan devised a plan for U.S. Steel to acquire TCNI, stabilizing the stock. But the deal required President Theodore Roosevelt's approval to avoid antitrust issues. In a tense late-night meeting, Morgan's partners convinced Roosevelt to tacitly approve the merger, averting. After years of debate and political maneuvering, President Woodrow Wilson signed the Federal Reserve Act into law on December 23, 1913. The act created a network of 12 regional Federal Reserve banks, overseen by a central board of governors. The new system was designed to provide a flexible currency, supervise banks, and serve as a lender of last resort. It was a direct response to the weaknesses exposed by the Panic of 1907, aiming to prevent future crises from. The Panic of 1907 reshaped American finance forever. It ended the era of private bailouts and ushered in the age of central banking. The Federal Reserve, born from the ashes of the crisis, has since played a critical role in managing economic downturns, from the Great Depression to the 2008 financial crisis. Yet, the debate over its power and effectiveness continues. The panic remains a stark reminder of what happens when a financial system lacks a safety net, and the Panic of 1907 was a watershed moment that exposed the fatal flaws of an unregulated banking system. J.P. Morgan's heroic but autocratic rescue proved that the nation could no longer depend on the whims of private bankers. The creation of the Federal Reserve was a monumental shift, establishing a public institution to safeguard the economy. While it hasn't eliminated financial crises, it has provided a crucial buffer against total collapse. The lessons of 1907